Hello, welcome to another talk on money, business, and investing. My name is Jose. I'm the founder of the company and brand here at Master Investor. Subscribe to our channel and leave a comment or a question if you have one. By the end of this talk, we're going to figure out how to avoid bad investments. That's today's topic. Our mission here at Master Investor is to elevate the financial well-being of humanity through high-quality financial education. Made simple, we look at opportunities to build passive income and true wealth. We are the global brand of money, business, and investing. Welcome to our community. Turn on the notifications and take notes, because remember that here in our community at Master Investor, we define investing as having a plan. We cannot call ourselves investors if we don't have a winning business plan. And more importantly than all of that is to know the exit strategy, even before we get into our investment. There are 5 asset classes that we can invest in. They all require financial education. And the 5 asset classes are: number 1, business; number 2, real estate; number 3, crypto; number 4, paper assets; number 5, commodities. It is important that we learn how to invest in all of them, because that is how we protect ourselves from down economies, and we can stay ahead of inflation. Because since today the economy works with printing money through debt, and we can say that money is debt and debt is money. It's not longer real money. It's an idea backed up by confidence. The more the Federal Reserve Bank, by the way, such bank is not federal because it's controlled by leaders around the world and nobody exactly knows who they are. And it's not a reserve because it prints money. And today is digital. So there is a portion that is printed and injected physically into the world, into the economy. And that's when we see that fiat money, that paper that people like to save in the bank, and or they like to put it somewhere under their mattress, which is not ideal because money loses value every day due to the fact that it's no longer backed up by gold. And we learned that happened back in August 15, 1971, where President Nixon separated the gold standard from the US dollar. From that point forward, money became monopoly money, fiat money, and just an idea, like I said, backed up by confidence. Once we understand that, and now we operate with the new rules of money, then we can successfully use debt to invest for passive income. In other words, if we have a credit card that has XYZ amount on it, and interest is X, Y, and Z, and we find an investment that we can put the entire credit card into that investment, and we have an exit strategy, we have a winning business plan. We know that the revenue of the business will cover the expenses of the credit card and the interest. And on top of it, it will leave us with positive cash flow. Now, if we're using 100% finance through debt to be able to acquire or build that deal, if we're using the credit card alone without using our capital and we're creating passive income, then that is literally infinite return on investment. That's what we call money for nothing. That's the holy grail, because that is tax-free wealth right there, legally, because all debt is tax-free because money is created with debt. So today the government works with debt. They want to do something, they print money, and the inflation rises. The dollar loses value because it's no longer backed up with gold like it used to before 1971. Before President Nixon separated the gold standard from the US dollar, then it was maybe okay to save some money because it was backed up by gold. So you could live just on the interest that the money was creating for the person at the end of the year, but just by having the money sitting in the bank. But that doesn't work any longer. We have to move our money from a cash flowing asset to another cash flowing asset. And that's what we are here to master, is to be able to raise capital, because that's the job number 1 of a wealthy entrepreneur. We're in the job number one of an inside investor or capitalist or a master investor is to multiply money and sound investing successfully fast, right? We need to get that passive income coming in quickly because that's the income that we thrive with. We don't make any other type of income except passive income and sometimes capital gains income, because some asset classes will only bring us capital gains income. However, rule number one here in our community of master investors is that we work to build passive income and multiply capital through sound investing, because that is literally what the ultra wealthy is doing daily. And when we master to put a deal together, then what happens is that money will come to us. And there's plenty of money in the world because we can always create new money from thin air, because the banks are in the business of what? Of lending money. And they do that to the people that they can see that they know how to operate a business and they know how to put a deal together that is valuable, because the more assets that the bank holds, the more money that they can print and they can lend through loans. And so it makes their CAMO score stronger. And the CAMO score is basically the credit score of the bank. The more assets that they have, the more money they can print with the money that they have from the savers. So what happens is that bank turns around, prints more money with the savers' money, and then uses that money to create loans to people that know what they are doing in regards to investing. We bring in deals that are sound to the bank and they can see it and they're betting on the deal. They're not betting on us. The bigger and the more sound the deal is, the bank will look at the deal instead of us. They take their eyes away from us because they're putting the money into the deal. And then we are the ones that are going to control the deal and the operation, make sure that the bank gets the payments every single month for the debt service or the payment, the cost of the debt that we acquire. So the key of becoming truly wealthy is to literally learn how to manage debt and be in as much debt as possible. So here at Master Investor, we do things straight to the ultra wealthy mindset. A lot of people out there will say that being in debt is not a way to become wealthy. And we say that the very opposite. We say that actually, in order to become truly wealthy, we have to learn how to manage debt and be in as much debt as possible. And the more we are successfully, the wealthier we become tax-free legally, because debt is tax-free. And that is why knowledge is the new money, because the more we know, the more we can capitalize. Make sure you visit our website, go to our products, and check out the digital courses. We have 3 books right now: How to Build Cash Flow with the Internet, Turn Passive Income On, The 10 New Rules of Money, and How to Invest in Crypto to Build Wealth. Stay tuned, because we will be releasing our 4th ebook, which is called How to Raise Capital to Build Wealth. And also our 5th ebook is coming out very soon. And a lot more products and tools that we're putting together on each digital asset that we have on our website, which whatever time we get in, we will be grandfathering for any other additional asset that we add into that digital course. So it's a win-win partnership. Take a look at the courses, add those business books into our libraries, because remember, knowledge is the new money. And we need to know what other people don't know about money. And we need to invest with the ultra wealthy context, which is very important. Find the red flags of any deal by using the following key points. Summary. The secret to profitable investing is to recognize the scams before they happen to us. Our investment choices should be based on reason, financial education, and due diligence. Remember that the most important words in the business language are cash flow. The second most important words are due diligence. We will understand why that is by the end of today's talk. It is more difficult for someone to take advantage of us the more we know. Bonus, at the end of today's article, we will learn how to budget like the ultra wealthy and not like the poor and middle class do. We could discover early on in our financial education journey that not all of the resources available are charitable. However, in a world where criminals are constantly searching for their next victim, being able to recognize warning signs and financial transactions is not only a skill, it is a necessity. Let's talk about a few things about avoiding these pitfalls over the years, often the hard way. Here are 10 essential tips below to help us avoid scams and make better financial choices. Number one, context is important. Context should be the first consideration for new investors. Where is the opportunity being presented, we ask, and how is the chance being offered? How is the opportunity that we're being pitched? How is it being offered to us? It is probably a fraud if someone is approaching us with an investment proposal in an odd or casual way, such as in a restroom or via unwanted emails or without a plan, etc. For example, at one conference, we were approached in the middle of a restaurant by someone who was trying to sell a substitute for a product that was being pitched at the event. Do they realize they are pitching us in a bathroom? Although it sounds amusing, the context made it clear to me right away that this was not real. Scammers frequently use anonymity or rely on reliable platforms to conceal their activities. Don't bite if we come across unwanted offerings in social media posts or podcast comments. A trustworthy investment will never come from an unreliable source or compel us to take rash action. Always question ourselves, does this setting make sense? And what's the plan? What's the exit strategy? What's in it for me? All of these questions are very important, and it's about the numbers. Do they make sense when we read the financial statement? So the more education we have financially, the better we are at avoiding scams. And a lot of people fall for them. We see it all the time. Two, offers that seem the numbers do not make sense after thorough due diligence should be avoided. Any investment that the numbers do not make any sense after we do a due diligence through the financial statements, then we should definitely pass it on, and we should never go into that deal because it's a liability. Generally speaking, if something seems too good to be true, it is not always a scam. We cannot be just driven by being skeptical about everything, because then we'll miss opportunities that may be good and they are true. We must do our due diligence before making assumptions. Scammers take advantage of our need for quick, simple gains. With less work, they will guarantee enormous profits in a short period of time. To put it plainly, there are no shortcuts when it comes to investing and building true wealth. The only shortcuts that exist, and we always say that, is by studying our mentors, the people that already have done what we want to do, and use their knowledge and turn that knowledge into our knowledge by applying what they have learned throughout the entire journey, so that we avoid mistakes that majority of people are making. And that way we could become ahead of the competition, and we are quantum leap into our ideal scene instead of going through the hard road of learning the hard way, of making the mistakes ourselves. So that's the only shortcut that we can actually have in life, is to learn from our mentors, which is very important. We always say invest in our financial education, invest in self-development, grow the leaders in our organizations, because that's how we grow our companies, and it starts with us. The company always reflects the owner. So who's behind the operation is what makes everything risky or not. And there's always risk. It's just either calculated risk that makes sense and the numbers work and everything is looked at and everything is checked off on the list, and we read the financial statements. We're measuring a return on investment with facts, not opinions. One of the difference between the wealthy and the poor is not only the way we spend our time when we have free time, or when we have the control of our time. And that's the whole purpose of building wealth, is to have control over our time at all times. And when people don't have control over the time because they're working hard at a job, now they only have a few hours that they can control. And in those hours, they usually tend to not get ahead because they're either relaxing and they're not doing anything to create passive income, which comes from financial intelligence and requires financial education. Without financial education, the person ends up giving their money away to either a scammer or somebody that doesn't know what they're doing, and they end up losing their money because they don't have an investment plan, they don't know an exit strategy, and they don't make money through passive income. Usually the person is a salesperson, it's not a capitalist or an inside investor. And that's what we want to become as we move forward in our journey of entrepreneurship, is to strive to be a capitalist, an inside investor, which is a master investor, someone that creates money with debt, creates wealth tax-free, uses our capital to raise more capital. We are creative, so we use other resources. It's not just our capital. We learn how to put a deal together, how to take it public. And becoming wealthy, ultra wealthy, and a capitalist can be dull, mechanical, and boring. And that's why people give up a lot of times, because humans are wired to do things that makes them happy. And once we become somewhat bored, we want to do the next funny or fun thing that we find. And we have to go through the boring things, even though we're going to do this to position ourselves to live through our passions and our purpose in life. We have to also do things that maybe we're not in love with, such as learning how to incorporate, or how to trademark, or how to speak to an attorney about taxes and about tax law, and how to get our CPA to do our taxes to match the ultra wealthy context. So we need a CPA that actually says, make as much money as you can, because we're minimizing taxes all the way to zero anyway. We have a tax strategy. All this money that we're making this year is going to be allocated in these places. We're going to document everything. We have the evidence, and we can minimize taxes because the tax code says so. It says that if we do this way, and we have the documents to back it, we can minimize taxes. And since we use debt, and since we are billions of dollars in debt, then we can actually have tax-free wealth this year. We're paying zero in taxes. That's the type of CPA that we want in our team, someone that understands the wealthy context and goes based on the tax code. And it's not a CPA for the middle class or the poor. There are two types of mindset when it comes to money: the wealthy mindset and the poor mindset. We have to have the context of the wealthy. And this is exactly what we're equipping ourselves with here at Master Investor, is all the tools and resources and the core values about money that we are updating, and we're shifting it to the ultra wealthy context, which is the main thing that people lack when it comes to building the wealth. It's not money that makes us wealthy. At the end, is our knowledge. A lot of people that win the lottery end up being broke. People that inherit money end up being broke, and usually they take their businesses or their parents' businesses or their family businesses to the ground, and they don't make it where it expands or it becomes a true brand, or they just lose the leadership that the business was built in. That's what's important, that we learn the basics of entrepreneurship and how to utilize leadership skills to create cultures and communities in true brands that have intrinsic value and business integrity. Intrinsic value means that we're protecting our assets through legalities. So if we need a patent, we have a patent. We have our logo protected, is registered, is trademark, our name. Intellectual property is in place. That is what turns a business into a true brand, is having intrinsic value. And business integrity means that it's making positive cash flow, because the business is built to raise capital from the front end, from the end users, on autopilot, because the product is solving a problem. And we need to peg the right niche so that we can continue to grow our database with more clients and we can expand. So we need to choose a product that people want to buy eventually. And the people that get the product, they will want to share with other people as well. We want to have a product that other people want to talk about it as well. So we need to answer those questions, and we need to write down what type of solutions we want to bring to the world. And we need to reverse engineer, do due diligence into the market that we want to go into. How many people can I get a day? How much is the profit? How much would I be able to acquire the product? Am I creating the product from scratch? Who's creating the product? Am I white labeling the product? I'm going to create the brand. I'm going to incorporate. We have to have a plan. And it starts with small steps. And it continues to be with small steps. It's all about the discipline and consistency that we have when it comes to building wealth. It's about understanding the basics of business, because the more we learn the basics, the better we can teach other people, and the better we can apply those concepts into our lives, because we're reminding ourselves constantly what we need to do and how we need to act when it comes to our investment strategies. A lot of people that lack knowledge when it comes to money, they fear business and investing, and they end up buying something, holding it, and praying, which is a poor strategy. We never want to pray into a deal that it may happen, because that means that the person measured that return on investment with opinions, which may never happen. We want to go with the facts, and those facts are found inside the financial statements of the businesses or investments that we go into. And we need to learn how to read financial statements. And we, as individuals, we have a personal financial statement, all of us. Therefore, we need to learn how to improve our personal financial statement, figure out how many assets do we have, how many liabilities do we have today, how many expenses, what are our expenses, our income, how do we make our money, how do we pay our bills. And we need to get the assets column going. If there's nothing in the assets column, we need to get our first asset. What is our first product that we're going to create or build or acquire to provide to the world? We need to find a solution, find a need, and then we need to fill it. And it's critical that we execute. It doesn't have to be perfect, because we're going to learn a lot through the ups and downs of life. We're going to learn the lessons behind the failures. And the more education we have, the more knowledge we obtain, the better we become at executing without having to learn the hard way. We can actually quantum leap into success overnight. So getting wealthy fast today, we can legally do it, because we have technology, artificial intelligence, we can sell worldwide. We don't have to have a lot of capital to start a business. In fact, we don't have to have any capital. We can start selling a product that is not even in our hands to the wide world. And if it's a good product and it goes viral, then the money came in before we even had the product. So we can actually create true wealth that is tax-free, because the new rules of money. Why? Because today money is debt. So let's go back to our list of 10 things that we should learn so that we can avoid bad investments. So number 2 was offers that the numbers do not make sense after thorough due diligence should be avoided. Genuine chances frequently involve risk and hard work. The pursuit of get wealthy and hard work, mentally hard work. It doesn't have to be physically. Remember, building wealth, once we get done doing our side of things, then the business is supposed to bring in wealth, meaning cash flow to us. It's supposed to bring in passive income on autopilot. So we're going to be making more by doing less. But yes, we have to put in the work at the beginning. We have to put in the time to build the business. We might have to stay up many nights, masterminding, getting that next client lined up so that we can continue grow the business to the next echelon, the next financial echelon that the business should be going to. It's supposed to continue to grow. As we depart from that business, we have the culture installed in it. We have the 8 integrities that makes a successful business extraordinary. Those 8 integrities, we find them inside of our ebook, How to Build Cash Flow with the Internet, Turn Passive Income Money. In the chapter where we explain the cash flow triangle, the 8 integrities are mission, team leadership, cash flow, communications, systems, legal, and product. Don't focus just on the product, focus on the other integrities as well, so that the business can be built in a solid foundation and nothing can bring it down. The pursuit of get wealthy with not risk schemes is one of the most common blunders made by novice investors. Like I mentioned earlier, investing has risk. It comes with risk. Everything in life is risky. So we have to calculate the risk, and we do that by understanding the numbers of the business, by having control over the business, over the investment. That's what's important, that we master how to raise capital, how to put the deal together, how to read financial statements, because with all of that in us, no one can ever scam us because we understand how to do business properly. A huge red flag is raised whenever someone promises outcomes or says their opportunity is risk-free. There's no such investment as risk-free, but there can be calculated risk, and it will feel like it's risk-free because everything is calculated and makes sense. Due to today's technology and artificial intelligence, we can get wealthy quick. A good bargain fulfills a valid market need and is based on real value. Stop and reevaluate if we are emotionally drawn to an offer. Examine the specifics. Investigate further or leave it if it is not making sense. Number 3, emotional cues are warning signs. Scammers are skilled at playing on people's emotions. They want us to experience feelings that can impair our judgment, such as fear, greed, or hurry. For instance, they may play on our worries about losing financial stability or caution us that we will lose out on exclusive deal. Many individuals have lost all of their life savings as a result of making decisions based only on their feelings and opinions. So one of the main difference between the wealthy and the poor, aside from investing our time into building businesses, and the poor usually invest their time in doing fun things before they focus on their finances and creating passive income. However, the other thing that they're different in is that the poor measures their investments or their money with facts, with opinions rather, and the wealthy, we use facts. We want to go with the truth because we go through the due diligence, because we have financial education. The poor doesn't have the financial education, so they go through life investing or trying to invest with opinions, and those opinions never happen, so they get discouraged and they never end up getting ahead financially. That's why it's important that we invest in our financial education. We continue to build our leadership skills, which comes from being able to bring smart people together and get the best out of them towards the mission of that business or investment. And it's not about being the best in our team. It's about having smart people around us, and we can lead them because we can withdraw their highest potential due to our leadership skills and our vision that we have and the opportunity that we bring into their lives as well. That's why it's important that inside of our communities, we also create a win-win partnership with the staff, that there's no cap for them to grow their income as well. because the more they can grow their income within our company, if the company is truly a capitalist country, a capitalist company, then we should definitely build it with those principles underneath, meaning that the staff can make more cash flow, more income as they bring more value into the organization. And we have people that will stay forever because they're making more money the more value they bring in. Therefore, they will be thinking at home about our businesses because they are happy that they can also become part of that gain if they bring something smart into the table. So we want to empower our staff. We want to create a win-win partnership. We want to empower them into positions where they deserve to be. And it could be the person that has the lowest position. It could be the cleaning person. It could be the secretary. If that individual brings something into the table that creates cash flow, then that person needs to be promoted immediately and needs to be given a certain amount of that cash flow as well. It's all about creating that win-win relationship all the way around, being transparent. There is a woman who, fearing that she would be flagged on the blockchain, fell for a Bitcoin fraud. Her accounts were depleted, and the con artist even persuaded her to take out loans in an attempt to fix the problem. Take a step back during a pitch. If we are experiencing intense emotions, our investment selections should be made based on reason and research, not feelings. Number 4, financial statements after an audit. Audited financial statements are among the first things to look for when assessing an opportunity. Why? Because it is difficult to fake them. An audited statement guarantees that the figures have been examined and verified as correct by a third party. We are taking a risk without this degree of openness. In order to entice investors, scammers can and frequently do inflate or fake financial data. The ability to comprehend financial statements is ubiquitous. The facts speak for themselves, regardless of whether it is a business, nonprofit, or investment opportunity. Learn to read them. We should back out of a deal if the financials are unclear or have not been audited. We have to be able to back down from any deal that is a liability, regardless of our emotions. Number 5, examine the marketing collateral or material. Excessive presentations and gaudy pamphlets are warning signs and of themselves. Genuine opportunities can market themselves without the use of gimmicks. In actuality, the finest offers frequently feature clear, uncomplicated information that are fact-based. The bigger the brochure, the worse the deal. It's a maxim to keep in our mind in this context. Why? Because a transaction needs additional packaging to appear desirable when it lacks substance. Number 6, recognize the team and leadership. Every successful investment has a solid team behind it. We should never invest if we don't trust the leadership. Find out who is responsible for the opportunity. Do they have experience? Have they previously delivered successfully? Inflating resumes is a typical tactic used by scammers. They may boast of irrelevant accomplishments or assert that they are serial entrepreneurs if they lack first-hand experience related to the current endeavor. That is pointless. Credibility is important. A strong leader has a proven track record of honesty and inspires confidence. Consider it a warning sign if we are unable to confirm their statements or if they are evasive regarding their past. Pay attention to the audited data, the numbers, and the history. Consider what they might be trying to conceal if all we are pretenses such as opulent pictures and grandiose claims. Number 7, there are legal scams. Not all scams are illegal. Despite operating inside legal systems, some continue to unfairly abuse investors. For instance, casinos are legitimate but made to gradually steal the user's money. Legal frauds in the investment industry frequently involve investments with unfavorable terms or poorly designed funds. Something is not always morally right or profitable just because it is legal. Examine the fine print and recognize who stands to gain the most from the agreement. Follow our instincts and move on if it feels like the odds are stacked against us. Number 8, start with what we know. If investing is new to us, stay with what we know. Although it can be tempting to seize novel and exciting chances, complexity can conceal dangers. Because they didn't fully comprehend what they were investing in, far too many people lose money. This is our circle of competence, as Warren Buffett puts it in. Don't invest in an opportunity if we don't comprehend it. Begin modestly. Select businesses or sectors that we are familiar with. Our portfolio can grow as our expertise does. However, before investing our money, always make sure we understand the basics completely. And we need to do our due diligence. When we do the research, we can determine whether there is something that we want to get into because it makes sense. We're going to see our money back. We know exactly when we're going to get it back, how much we're going to keep getting after we obtain our capital, our initial capital, invested capital back. And we want to reach infinite return on investment. That's what we call money for nothing. That's when we have recouped the initial capital back and we continue to receive passive income. And it's tax free because usually we're using debt, and passive income can be brought down all the way to zero in taxes as long as we allocate the passive income into the right places with the right documentation backing it, align with this tax strategy that we have with our tax planner, our bookkeeper, and of course our tax attorney. So we must invest when we have a winning business plan, we have an exit strategy, we know everything about the business, we have control, and it's a win-win partnership. Whatever we're doing, it's creating a win-win for everybody involved. Number 9, risk management and positioning sizing or position sizing. An essential component of profitable investing is risk management. Never put all our eggs in one basket, no matter how good a deal looks. It's all about diversifying among the 5 different asset classes, as we said earlier on our talk. That's how we minimize our danger when the economy goes down. And that's how we protect ourselves from inflation, is by diversifying among the 5 different asset classes for passive income. And sometimes we'll get capital gains income, but specifically we have to focus on passive income. And it requires more financial education, more leadership, more self-development. So it's a higher commitment for those who really want to go the route of becoming ultra wealthy beyond our dreams. Our friend is diversification. We lessen the impact of any one failure by distributing our assets among several prospects. For instance, an investment is probably not a good fit if it takes 100,000 and that's all we have. As our portfolio and confidence increase, start with lesser position sizes and work our way up. Staying in the game long enough to take advantage of future possibilities is the key to risk management. Number 10, ongoing financial education is essential. And lastly, never stop learning. The best approach to protect ourselves from fraud is to keep knowledgeable about the constantly changing financial world. Read books, enroll in classes, and pay attention to reliable professionals. Keep in mind that it is more difficult for someone to take advantage of us the more we know. Prioritizing education can help us not only steer clear of bad bargains, but also put ourselves in a position to recognize good ones. Every investment should be made with as much information as possible. The return on investment should always be measured with facts, not opinions. These are the 10 essential guidelines will safeguard our funds and enable us to make prudent investments. Remain alert, educated financially, and have fun with our investments. Bonus, how to budget like the ultra wealthy, making a budget like the wealthy. The wealthy do not compare our income and expenses using a budget. Instead, we see it as a means of getting ready to make more money. So when we budget, is to make a plan, and we're planning for that money to go into somewhere, into an asset, specifically a cash flowing asset that will multiply that capital and will bring that capital back to us and will continue to create more money to the point that it will take us to infinite return on investment, where it's money for nothing and it's tax-free legally. In other words, instead of saying we don't have enough money like the poor do, or how much extra money we can spend, we question how can we make more money? And there's always enough money because today money is created with debt. And all we have to do is have confidence behind our plan. And we have to show the facts. How can we make more money? The middle class will say. A person with a wealthy mindset will have the following personal financial statement. So how we make more money, how do we raise capital, is how we use other people's money successfully and legally through debt, through a loan, through a credit card. If we meet a private investor and we present the idea that private investor has capital to invest, if we meet a seller and that seller has confidence on their business and has been making them XYZ per day, they might be willing to do seller finance, and we use their credit, we use their faith on their own business, that we would use the cash flow of that business to pay him for the next 30 years. So we'll give you what you want with our terms. We'll pay the price that you want. However, we'll do it with our terms. We use the cash flow from the business every day, and we'll give you a percentage every day for the next 30 years, and we'll pay that price. And a lot of times it happens like that. So we can use other people's money. We have to become creative when it comes to building wealth. And when we budget like the ultra wealthy, which is to budget to become wealthier, not to shrink like the poor and middle class do. The poor mindset wants to shrink. The ultra wealthy mindset, we budget to make more money. Where are we going to put this money to make us more money, to bring this money back and also continue to bring us more money? So as we're looking at here on our screen, we have the cash flow pattern of the wealthy class. We see a financial statement, and in that financial statement, we see the assets column is being filled in with assets that pumps cash flow into our income column, and that income is used to go into our liabilities column, go to our expenses column, and in a lot of the times we can be so sophisticated that we use our expenses to bring it back into our asset column, because we turn some of our expenses can be turned into assets. It can come back into our assets column. That passive income, that cash flow can flow back into our assets column, because our liabilities can become assets as well. Some liabilities can become assets, because every liability that we have on our liabilities column is somebody else's asset in their financial statement, whether it's the bank's asset or somebody else is having that liability in their asset column. However, we can turn that liability on our financial statement into an asset majority of the times. We need financial education for that, and we need to take a look at what type of liability we're looking at, because not all liabilities can be turned into assets. The wealthy don't consider our current income when deciding if we can afford the gadgets we want to enjoy or the luxuries, right? We first focus on creating an asset, and we say, okay, we'll use that asset to pay for the cost of that liability. Rather, we inquire as to how much more we will have to create through investing in a cash flowing asset in order to pay for it. We then locate assets and investments to pay for the additional costs and all expenses in our lives. Therefore, we are always living above our means and not below our means. We are always expanding, not shrinking. When we operate like the ultra wealthy, then our lives are easy with total freedom. The ultra wealthy, we focus on purchasing assets first and pay taxes after, if any. As we can see on our financial statement, our expenses shows that number one expense is acquired assets. So as our income comes in, our expenses, the first expense we have is acquired assets. We already have a plan for that income to be put into as an expense, a good expense, into an asset that will produce passive income. Wealthy people buy or acquire assets first before tax dollars and pay zero in taxes in many occasions. Then we acquire liabilities by having the assets pay for the expenses of liabilities. All is done legally using the tax laws and corporate law. So our expenses, as we can see here on our financial statement here, simplify on our screen. It shows, number one, acquire assets on our expenses column. Number two, pay taxes, if any. Number three, acquire liabilities. The cost of investing is essentially the first expense in our budget. This generates passive income, or known as positive cash flow, which eventually pays for the fun items in our wish list. We want more money by doing less and acquire more possessions as a result for free because our investments pay for everything. Our expenses are covered by our positive cash flow. Our debt service and any debt that we have is also covered by our positive cash flow. Everything, all the expenses. We thrive through passive income, or also known as positive cash flow. Our attitude toward budgeting is the root of it all. Now we need to look at how our personal financial statement looks like and how we will improve it. That is the next task we must execute to build true wealth. The key of building true wealth is to legally figure ways to raise capital to invest using OPM, other people's money, paying zero in taxes legally because all debt is tax-free, and increase control on long-lasting cash flow and assets. We must be creative to not only use our own money to invest, but rather use other people's money too, as it is more beneficial and provides us leverage to our positive cash flow that is tax-free. That is a capitalist, which is the highest level of an investor. Someone that masters the ability to turn an idea into a real brand that others are eager to use the products the company delivers to the world. We want to have people lined up for our ventures, and that requires leadership, requires self-development, a commitment to financial education, and taking massive action. And start investing in high-quality financial education here with us at Master Investor. Get our ebooks, get the 10 new rules of money, how to build cash flow with the internet, turn passive income on, how to invest in crypto to build wealth, understanding Bitcoin and blockchain, the rise of legitimate reserve digital currencies and assets. Go to our website. I hope that we learn a lot today on how to avoid bad investments. We have 10 key points that we master. Let's apply them into our daily investment strategy. Put a plan together, begin to execute, and remember the exit strategy is the most important thing when it comes to invest, and we want to know exactly when are we getting our money back, because that's the point that we reach infinite return on investment. That's the holy grail of investing. That's when we have no money into the deal and we still control the deal and making money from that deal. That's money for nothing. Thank you for having me once again. Glad to be here again on another extraordinary talk on money, business, and investing, bring you the good and bad news of money, the business principles that work in all economies. Let us know if you have any questions. We're going to come back and answer and open a dialogue on today's topic. Subscribe, like, and share. Stay extraordinary and wealthy. Bye for now. Talk to you later.